here to hear a February budget forecast presentation from MMB. And with that, I'll welcome to the table Commissioner Campbell, Budget Director Anna Mengi, and Dr. Anthony Becker, the state economist. Thank you for coming to join us, and please proceed in whatever order you wish.
Well, good morning, Mr. Chair and members. I'm Erin Campbell. I'm the Commissioner at Minnesota Management and Budget. With me today are our state economist, Dr. Anthony Becker, and our state budget director, Anna Mengi, and we'll present the February 2026 budget and economic forecast. As a reminder, Minnesota is one of 13 states that show a 4-year window into our state's budget and economic outlook in our twice-yearly forecasts. That enables us to not only gauge near-term economic conditions, but also to plan for circumstances that might arise in the next biennium. When we prepare forecasts, we are analyzing a large amount of data, and the forecast represents the best financial projections that we can provide based on the information available when we prepare them. In this forecast, we continue to refine our projections for fiscal years 26 and 27, which will provide essential information that policymakers need to consider in supplemental budget discussions. We will also update our projections for the planning years FY28 and 29. And after our presentation, we'll be happy to take your questions. There is good news in this forecast, but there are significant risks that remain. Minnesota is in a strong financial position. We now project to end fiscal years 26-27 with a surplus of $3.7 billion, which is $1.3 billion more than forecast in November. Left unspent, that surplus carries over into fiscal years 28 and 29. Those funds carrying forward are key to ending the planning years with a positive balance. As a result, we're currently forecasting a $377 million positive balance in FY28 and 29. The increased projected balance in both biennia is due to a slightly improved national economic outlook, which drives an increase in forecast revenues, particularly in individual income and corporate franchise taxes. When it comes to individual income tax revenues, we are seeing a shift away from some of the typical drivers of the revenue increases in this area, like wage and salary, to more volatile sources. Higher wages and more people in the workforce traditionally drive increases in revenue from individual income taxes. And wages do, in fact, continue to rise. However, employment growth is weak, both nationally and here in Minnesota, and demographics and changing immigration policies are shrinking the pool of available workers. Instead, what we're seeing now is that capital gains and interest earnings, which are sensitive to even small changes in the national economic outlook, propel much of the increase in individual income tax revenues. As Minnesota becomes more reliant on these revenue sources, we're seeing and should expect increased volatility. As we've discussed in previous forecasts, we have also seen unprecedented growth in corporate tax revenues. And while this is good news, it is worth noting that this has long been our most volatile revenue source. Dr. Becker will discuss this in more detail, but the lack of access to relevant federal data due to the federal government shutdown does have potential implications for our revenue forecast, particularly when it comes to volatile revenue sources. In Minnesota, we are experiencing unprecedented threats to the federal funding that we rely on. Any loss of federal funding is problematic, but particularly for entitlements, where it would result in significantly increased costs for the state to provide legally required services without the benefit of federal aid. The potential implications to the Minnesota budget should not be underestimated. And the structural imbalance, or the amount spending exceeds revenues, continues to be an issue in this biennium and the next, and that's even after the improvements in the revenue forecast. I do want to note that the significant actions taken by the governor and the legislature in the enacted 2027 budget have helped drive a positive balance in FY28 and 29. And while the structural imbalance was not eliminated, it is improved in part due to those budget decisions. This slide shows a projected FY26-27 budgetary balance for this forecast in the middle column compared to the November forecast on the left. The column furthest to the right shows the difference between the two. At the top of the slide, you see our beginning balance for the current biennium is nearly $10.3 billion. That money represents carry forward from the last biennium. Our revenue estimates for the current biennium are up $1.2 billion from the November forecast, and spending projections are down $68 million. The projected balance at the end of fiscal years 26 and 27 appears under the lowest horizontal line. As you can see, we now forecast a positive balance of more than $3.7 billion. Excuse me. This next slide should look familiar. It shows a forecast horizon and the impacts of one biennium on the next. We show it to help people understand how money moves. Before I get into the contents of this slide, it's important to remember that when we started this current biennium in July, we had the benefit of significant carry forward from FY 24-25 of $4.8 billion. This is important because we do have a structural imbalance in the current biennium of $908 million. So that starting balance less the structural imbalance leaves us with a projected balance of $3.7 billion. So if you're looking at the screen, starting with the dark blue column on the left, this shows the $3.7 billion that we project will be available at the end of the current fiscal years. Left unspent, that carries forward to become the beginning balance for FY 28 and 29, as you can see with the dotted line. When you move to the middle column in gold, you can see the projected structural imbalance of just under $3.4 billion. This is the amount that the projected spending will exceed revenues generated in that biennium, as well as discretionary inflation of over $1 billion. When you subtract that from the $3.7 billion beginning balance, we're left with what you see on the far right in dark blue, $377 million at the end of the FY 20 and 29 biennium. Discretionary inflation is included in the forecast to give policymakers a sense of what it would cost to maintain state services at the current level. If we were to not include discretionary inflation, which as a reminder, legislators are not required to budget for, we'd have a projected positive balance of slightly more than $1.4 billion at the end of the planning years. With that, I'd invite Dr. Becker to cover our economic and revenue outlook.
Thank you, Chair Marty, members of the committee. I am Anthony Becker, Minnesota State economist. Since the budget and economic forecast was last prepared in November 25, the state's revenue forecast for the current and next biennia has improved due to changes in the Minnesota and U.S. economic outlooks. However, at the same time, these changes and long-term trends in the composition of state revenues have increased the volatility of the state's revenue stream. Further, weak labor market conditions and federal policy uncertainty on trade and tariffs add uncertainty that continues to cloud the economic outlook. Our macroeconomic consultant, S&P Global Market Intelligence, or SPGMI, released their baseline forecast to us on February 6, 2026. Due to the federal government shutdown in October and November and the partial shutdown in early February, certain key pieces of data that are typically available for SPGMI's February forecast were unavailable to them. The data include the fourth quarter 2025 release on gross domestic product, GDP, and its components, including corporate profits, the January 26 employment situation report, and also consumer prices in October 25. On trade, SPGMI assumes an effective tariff rate, or assumed, I should say, an effective tariff rate going forward of 14%. That was 4 percentage points lower than they had assumed in November. But the recent Supreme Court decision invalidating the IEEPA tariffs happened after SPGMI's forecast, as did the new Section 122 tariffs of 10% that the administration announced. And so those tariffs are not included. We're waiting for a further forecast from S&P to see what their tariff assumptions are. In this next chart, we have SPGMI's forecast for gross domestic product through the end of the forecast period. Here, the overall outlook for growth has improved since November, with higher growth in 2025 and slightly higher growth in 2026, mostly due to an assumption that strong growth in quarters 3 and 4 of 2025 will carry forward into 2026. As in November, GDP growth remains below trend in 2027 and beyond. This means that employment demand is unlikely to be robust in the years ahead, and further, a low-growth economy can more easily slip into recession as a result of an adverse external shock. Turning to real consumer spending, consumer consumption, real personal consumption expenditure, or real consumer spending is the primary driver of growth in the economy, accounting for roughly 70% of GDP. SPGMI now forecasts real consumer spending will grow 2.8% in 2026, 0.7 percentage point higher than they had assumed in November. From 2027 through 29, real consumer spending is expected to grow at 2.2% per year on average. Despite rising incomes and rising spending, we are observing some signs of consumer stress, with higher delinquency rates in certain loans: credit cards, auto loans, and student loans. Delinquency rates in these three areas are reaching levels comparable to those during the Great Recession. However, home loan delinquency rates remain at historically low levels. Now, for inflation, compared to the November forecast, inflation is projected to be slightly lower in 2026 and higher from 2027 through 2029. The lower near-term inflation reflects a lower assumed average effective tariff rate than they had assumed in November, and lower inflation that we experienced in late 2025. Overall, inflation in both the CPI and core personal consumption expenditure indices is expected to remain elevated through 2027 before gradually easing in 2028. Now, corporate profits are now forecast to grow 9.5% in fiscal year 2026. That's 7.4 percentage points stronger than projected in November. In fiscal year 27 and beyond, corporate profits are forecast to show minimal growth. Minnesota's corporate franchise tax is closely related to the level of corporate profits and is the state's most volatile revenue stream. The volatility makes it difficult to forecast this component of revenues with great precision. Minnesota's unemployment rate has continued to increase over the past year, both absolutely and relative to the national rate. In December, Minnesota's unemployment rate was 4.1%, up 1.1 percentage points from a rate of 3.0% 1 year ago. Although the unemployment rate has risen, Minnesota's rate remains below the national rate, and the state's job market remains favorable to job seekers with more vacancies than unemployed workers. And while this forecast does not include a recession, we are following labor market conditions closely, as some labor market indicators send early signals of economic contractions and expansions. Now, a significant driver of our individual income tax forecast is the forecast for total wage and salary disbursements, and that forecast has changed little since November. In this forecast, increases in wages and salaries, though, is not a main driver of the increase in individual income tax revenue that we forecast. Rather, that increase is driven by increases in non-wage income, principally capital gains distributions, which vary much more year to year than does wage income. SPGMI's forecast of the Standard & Poor's 500 stock index is one determinant of our forecast for non-wage income. Their February forecast is substantially higher than their November forecast for the S&P 500. In November, they projected a 12% multi-year downward correction in the index, with the market declining through late 2028. The current forecast assumes a much milder correction of only 4% down and a recovery beginning in 2027. This higher level of the S&P 500 translates into higher wealth for households. Higher wealth leads to higher capital gains realizations, and this is causing much of the increase we are forecasting in state income tax revenues. Equity markets provide both upside and downside risks to the forecast. If equity markets continue their current upward trend, we will see greater levels of consumer spending and higher non-wage income, both of which will increase state revenues beyond what we are currently forecasting. On the other hand, if we see a substantial decrease in market values, both income and spending would likely fall. Now, turning to our revenue forecast, the first two columns of the table show the February forecast for the current biennium and the change compared to the November forecast. The second set of columns show the same information for the planning year's biennium. Total revenues for the current biennium are now forecast to be almost $68 billion, 1.8% more than in the November forecast. We're now projecting individual income tax receipts to be 1.9% more than we projected in November. This increase is primarily due to higher forecasts for individual income tax liability in tax years 2025 and 26. The higher tax liability forecast is largely driven by higher forecasts for non-wage income sources such as capital gains realization, interest income, and IRA distributions. Through January 26, individual estimated tax payments for tax year 2025 are well above our November forecast, which is consistent with higher tax year 2025 tax liability. Technical adjustments and higher forecasts for net partnership and S-corporation collections further contribute to the forecast change. And this is consistent with stronger net collections we've observed through January. General sales tax revenue is now forecast to be nearly $16 billion, 0.5% more in the current biennium than in the November forecast. This increased forecast reflects a higher forecast for consumer spending on goods and services subject to the sales tax. The corporate franchise tax is forecast to generate $6.6 billion in the current biennium, 5.4% more revenue than in the November forecast. And this forecast change is due almost entirely to higher corporate profits forecast as shown previously. Other revenues to the state are now forecast to generate almost $10 billion, 1.2% more than in the November forecast, due primarily to an increased forecast for investment income, the return the state earns on its cash balances, including the budget reserve. Now, as I noted previously, higher forecasts for non-wage income sources are primary drivers of the higher individual income tax forecast. The non-wage share of gross income reported by Minnesota taxpayers has been increasing over time, and we expect this trend to continue. Non-wage income sources such as capital gains and interest income are more variable from year to year than our wage and salary income. As a proportion of personal income tax coming from more volatile sources rises, the overall volatility of income tax collections rises. Further, over time, the proportion of general fund revenues coming from the more volatile corporate franchise tax has also risen. The overall effect is that the volatility of the state's revenue stream is increasing. Now, there are many risks to this forecast, and first among these risks are the policy uncertainties at the federal level, especially regarding trade, tariffs, and immigration. Trade uncertainty may induce businesses and consumers to take on less debt, suppressing both private investment and some forms of consumer spending. Tariffs are mostly passed through to domestic buyers and so also contribute to higher prices and higher input costs for businesses. The administration's immigration policies also produce forecast risk through the potential to create labor shortages in business sectors dependent on immigration for new workers. The recent federal shutdown disrupted the usual collection and dissemination of federal statistical data as previously discussed. The missing data due to the shutdown clouds our picture of economic growth, corporate profits, inflation, and labor market conditions, adding uncertainty to our revenue forecast. It also makes it more difficult to assess the reasonableness of SPGMI's forecasts of inflation and exchange rates. Equity markets present both upside and downside risks, as I've already mentioned. The assumed path of monetary policy depends on both inflation and labor market conditions. Because of the trade uncertainty and weak national employment growth, there's limited clarity about monetary policy through the forecast horizon. The adoption of artificial intelligence provides both upside and downside risks. The upside or positive risk is that higher levels of capital investment and increased labor productivity will raise the nation's output. The downside risks include the possibility of job losses from AI adoption and that there is an AI investment bubble which may burst. I would add also at this point, we're seeing considerable risks from energy price shocks going on in the economy, and these will present both difficulties for consumers as well as increased input costs for businesses. Finally, there are 17 months remaining until the end of the current biennium, and it's difficult to forecast macroeconomic conditions with great precision a year and a half ahead. I'll now turn the presentation over to State Budget Director Anna Mingy.
Good morning, Mr. Chair, members of the committee. I'm Anna Mingy, State Budget Director with Minnesota Management and Budget. I'll be walking through changes in this general fund spending forecast, and then the Commissioner will provide an overview of our long-term budget outlook. So this table outlines changes in anticipated general fund spending in the current biennium and the next. You can see we have a column in each biennium for our current forecast, as well as whether that has increased or decreased from our November estimates. At the very bottom, you can see that in total, we project spending this biennium to be $70.2 billion, a decrease of $68 million from previous estimates. But the planning estimates have increased by $152 million since our last forecast. So I'll walk you through the table to give a sense of what's contributing to this change. The very first policy area, E12 education, here spending is projected to be higher in both biennia, $111 million in the first biennium and $257 million in the second. These increases are a result of higher spending on special education, where costs have grown as school districts spend more on compensation and benefits for staff and serve a growing number of students. I will discuss this in more detail on the next slide. On the next line, Health and Human Services spending is projected to be $162 million below previous estimates this biennium and $199 million in the next biennium. This reduction is largely driven by the implementation of a new prepayment review process in the medical assistance program, which I'll discuss more in a moment. On the next line, you can see property tax aids and credit spending is $18 million below previous estimates this biennium. And spending for debt service and all other areas of the budget is largely unchanged from the November forecast. Moving to the next line, I'll remind folks that our forecast does include an estimate of discretionary inflation in 2028-2029. We estimate this cost to be $1.039 billion, which is $104 million more than we forecast in November. This increase is due to a slightly higher forecast of CPI, which, because it's applied to a large base, a small change can drive a $104 million increase pretty easily. This number, as a reminder, is meant to be a guide for policymakers about the cost of maintaining current services as prices grow. It's important to emphasize this money is not automatically flowing to programs. It has to be appropriated by the legislature. So policymakers have the choice to address inflationary pressures using this money that we hold in the forecast. So next, I'll discuss some of those key changes that I highlighted on this slide, starting with special education. As I just mentioned, special ed costs are responsible for the upward revision in our spending forecast for education. If we, the numbers you just saw were for the whole education bill area, but if you look just at special education, our costs in this program have increased by $112 million in this biennium and $350 million in 2028 and 29 relative to our November forecast. This growth is on top of some significant increases that we saw in the November forecast. This change is a result of updated data about school district spending on special ed services in the 24 and 25 school year. In November, we only had partial information, but we now know that school spending on special ed grew by 10% in last year relative to the previous year, compared to the 6% that we assumed in the November forecast. The annual rate of growth for school special ed spending has risen significantly in recent years, which has driven revisions in the state spending forecast. And those revisions are what you can see on the chart in front of you, which shows actual and forecast state special ed spending from 2020 through 2029. During this time period, spending is growing from $1.6 billion in 2020 to about $3.6 billion by 2029. While some of the changes in spending can be attributed to proactive policy change enacted by the legislature, overall growth in local education agency spending continues to rise forecast over forecast. And so that updated information about school spending is what's driving revisions in the forecast, which you can see represented by those dashed and dotted lines under our current forecast. So now I'll move on to discuss changes we're seeing in the Health and Human Services forecast. As I just mentioned, this forecast is the first to incorporate experience from a new prepayment review process for certain medical assistance benefits. In late October 2025, the Minnesota Department of Human Services announced a new process to suspend and review claims for 14 high-risk Medicaid benefits. This was intended to provide additional time to identify suspicious patterns and anomalies. So DHS contracted with a third party for this review and has established an ongoing prepayment review process for these services. And this process, this process has impacted the forecast in 3 ways. The most immediate impact of the new review process is that there is a delay in the payment of fee-for-service claims for these 14 services. The additional review results in requiring more time, which drives a 2-week delay in payments for the 14 services. The fact that we've just delayed sort of payments for these services by 1 billing cycle into perpetuity in the forecast results in a savings of $53 million in the current biennium. So those are some one-time savings relative to the November forecast. The most significant and ongoing impact of prepayment review comes from the fact that we are seeing lower billing by providers, which some have referred to as cost avoidance, and that's represented by the bright green on the chart. Through an analysis of claims from before and during the implementation of the prepayment review process, DHS estimates there will be about 4% lower spending in these 14 services as a result of providers billing less. This cost avoidance is expected to decrease state spending by $75 million this biennium and $99 million in the next. The third and smallest forecast impact of the new process is the denial of claims that would have been otherwise paid. With this process, claims for impacted benefits are reviewed using targeted analytics, and if a claim is flagged for further review, it goes to DHS staff who reviews it and determines whether to approve or deny the claim. So based on early data, DHS projects an increase in denials, which reduces state spending by $5 million this biennium and $6 million in the next. So in total, the incorporation of this experience lowers the spending forecast by $133 million this biennium and $105 million in the next. So now I'd like to move to discuss a risk to the spending forecast, which is not directly reflected in the forecast, but was an important piece of our budget outlook. As we've discussed in previous forecasts, federal funding is a really important piece of the state budget. Federal dollars represent 1 of every $3 spent by state government. At MMB, we pay particular attention to federal funding that supports state-level entitlements. So these are obligations that we have to Minnesotans based on state law to provide a service regardless of federal funding levels. We estimate about 2/3 of our federal dollars go to supporting those entitlement services. In these cases, the loss of federal funds would create a direct budgetary impact to the state. Federal funding for entitlement programs has been more volatile in recent months as a result of both congressional law changes and administrative action. And there are a number of outstanding risks that aren't reflected in today's forecast. One of those is related to actions taken by the Centers for Medicare and Medicaid Services, also known as CMS. This is the federal agency that oversees our medical assistance program. On January 6th, CMS indicated their intent to withhold $515 million per calendar quarter from the state's medical assistance reimbursement. That action is currently pending an administrative appeal, and the loss of those federal dollars is not reflected in the forecast. Also, earlier this month, or last month, we received additional notice from CMS that they would defer $260 million from our Medicaid reimbursements, pending further information from the state to justify claims flagged by the federal government. That, because we are in sort of an intermediate period there, those impacts are also not reflected in the forecast. There's also budgetary risk from the fact that state laws are out of alignment with federal law. H.R. 1, the Federal Reconciliation Bill, made a number of changes to federal law, some of which have to be implemented by states by January 1, such as the implementation of work reporting requirements. If state law is not amended to align with this change, we stand to lose significant federal funds supporting these programs. There have also been recent attempts by the federal government to freeze funds supporting child care and MFIP benefits. Although none of those impacts are currently reflected in the forecast, if they were to occur, it could dramatically alter the budget outlook. And now I'll turn it back to Commissioner Campbell.
Thank you, Anna. This slide shows the long-term budget outlook, and it compares our forecast revenues against our estimated spending for the current biennium and the next. And that's without any unspent projected balances or transfers to our budget reserve. This view is what we call our structural balance. As you can see, forecast revenues of $67.5 billion in the current biennium are expected to grow by $2.5 billion in the next, an annualized growth rate of 1.9%. During that same time period, we're expecting baseline spending of $68.4 billion to increase by nearly $4 billion, or 2.9% on an annualized basis in the FY 28-29 biennium. If you were to include appropriation carryforward and discretionary inflation, total spending is expected to exceed $70.2 billion in the biennium and grow $3.1 billion to a total of $73.4 billion in the planning years, an annualized growth rate of 2.2%. So stepping back, when we subtract total forecast spending in the planning biennium from expected revenues in that same time period, you end up with a structural imbalance of nearly $3.4 billion, or $2.3 billion if you were not counting discretionary inflation. Despite tremendous progress, more work is needed to address the ongoing structural imbalance to align revenues and spending. You can see on this slide how our budget reserves have grown over the years thanks to our nation-leading budget reserve policy. With the addition of $244 million last November, our total cash flow and budget reserve funding remains at a record high of $3.8 billion. Those reserve dollars not only protect us against an unexpected loss of revenues in the current biennium, they also help us maintain our AAA bond ratings and our reputation as a financially well-managed state. As I close, I want to reinforce that the state of Minnesota is on strong financial footing. We have a very healthy projected balance in FY 26-27 of nearly $3.7 billion. And despite a persistent structural imbalance, we expect to end this biennium and the next with a positive balance, and that's a big improvement, particularly from November and in fiscal years 28 and 29. Additionally, we have a nation-leading automatic allocation to our reserve, again, meaning that we have funds to address an unexpected revenue shortfall should one occur in the current biennium. Just a note here that in light of Minnesota's increased dependence on more volatile revenue sources, there may be adjustments that are needed to the budget reserve target level to better capture those heightened risks. We also have AAA bond ratings, again demonstrating rating agencies' continued confidence in Minnesota's responsible financial management and our history of taking actions to keep the state on strong financial footing. And we do have time to work on the structural changes needed to bring spending and revenue in line to avoid a future fiscal crisis. Still, it would be important for policymakers to keep a few things in mind as they make decisions this legislative session. First, the volatility of the revenue that's driving the forecast improvement, and in particular in light of relevant macroeconomic data that did not arrive in time to be included in the forecast. Even the most recently released GDP and corporate profits data could have meaningful impacts on available revenues, as well as recent events with the stock market and other we can talk more about. As we've mentioned, continued federal funding uncertainty could have impacts on the general fund bottom line. We do know that any new spending for this biennium will impact the projected positive balance of $377 million in FY 28 and 29. And finally, our structural imbalance does continue to be an issue. Alignment of spending and revenue will need to be addressed, and the sooner we begin looking for additional ways to do that, the less likely we are to face a future fiscal cliff. Given these considerations, policymakers should, in MMB's opinion, at a minimum, strongly consider offsetting any new spending this legislative session with spending reductions to be mindful of both the FY 28-29 projected balance and the structural imbalance. I want to once again acknowledge the important work done last legislative session that has had a material impact on this forecast. That fiscal discipline will remain important in this legislative session and the next. As always, MMB will continue to watch for significant changes through monthly revenue updates, quarterly economic updates, and our close monitoring of federal actions, providing all of you and others the information needed to anticipate and respond to economic changes. And with that, we're happy to take questions.
Thank you all for the presentation. Are there questions from members of the committee? Senator Howell, then Senator Champion.
Thank you, Mr. Chair. And I guess my question is how significant is the impact going to be if we do not comply with the federal measures that are already there? Which way is it? I already kind of assume which way it's going to go, but how significant is that? And is that a real pressure point for us to find that federal compliance?
Director Mengy.
Mr. Chair, Senator, so with regards to the sort of HR 1 compliance for Medicaid, things like Medicaid work requirements and sort of 6-month redeterminations for the adult expansion population, the federal government has not specified for us what the penalty could be. They have structured penalties differently in different cases. There, I would say, sort of the federal share supporting the Medicaid expansion population is over $3.5 billion a year. So if, I think that would be sort of the most extreme circumstances would be if they essentially determined that this group was no longer eligible for federal Medicaid funding. But I, without additional federal guidance, can't speak to the likelihood that that is what it would be. But that's sort of the upper bound.
Other, Senator Champion said no questions right now. Any other questions from members of the committee? I have one, Director Mengy, on the cash flow, the last chart. I noticed it hasn't changed since 2012. And I remember before that we had some problems a couple years with volatility and it's short where the money wasn't coming in at the right times. Is that still more than sufficient? Is the cash flow problem no worse than it ever? We're safe, in other words. Is that the question?
So, Mr. Chair, we have very significant cash balances at the time because of the size of unspent funds that have rolled forward and the general fund budget reserve. Those are available to us to manage cash shortfalls. If there was a downturn in the economy that led to us being, closer to a deficit, I think we would probably need to evaluate the adequacy of that. That number, as you know, is set in statute, the $350 million.
I was neglecting the thought that, yes, we have the other money we can use before we ever would need that, but okay, thank you. Senator Pratt.
Thank you, Mr. Chair and Commissioner Mengy. Back in December, we had quite the conversation around the impact of fraud on the budget and trying to get our arms around how much it was actually having an impact. Can you give us a status on where we're at on that?
Mr. Chair, Senator Pratt, the forecast is a forward-looking budget tool. So to include fraud in the forecast, from our perspective, doesn't make much sense because if we knew that there was fraud that was happening in state agencies, we wouldn't continue to project that spending. We would work to stop the fraudulent activity. So maybe like as a baseline would say that. The other thing I would just note is when we do forecast, the nature of a forecast is that we're continuously evaluating whether spending and revenues have increased or decreased based on a variety of factors. And that has occurred in both this forecast and the last. And so you have seen in the November forecast rather, the impact of having stopped housing stabilization services. I believe that was, these numbers are going to be rough, but I believe it was an impact of a savings of $70 million in the first biennium and around 102 in the next. And then in this forecast, you see the impact of the prepayment review that is happening with medical assistance. And over the forecast horizon, I believe a savings of $238 million. So that is how you see the impact of fraud on the forecast.
Senator Pratt.
Thank you, Mr. Chair and Commissioner, and I appreciate that. And I understand the forecast is a forward-looking document, but the governor had promised that we would do kind of a full accounting on what the impact on the state's finances have been with fraud, whether that's, adjusting the baseline from where we were at, or just having accountability to Minnesotans that, you know, as I'm out in my community, it still is the number one issue that that comes up with residents, and I think we owe them an answer. Thank you, Mr. Chair.
Dr. Becker, I guess one of the questions when I see all the uncertainties right now, I just wonder, you always have a upward estimate and a downward estimate, and so the volatility stuff, is that significantly worse than it would have been 10, 15 years ago, just overall? And then I have one follow-up about what's going on right now.
Yeah, Mr. Chair. Yes, the volatility of the revenue stream for the state is higher. And that's a result of really the shift in the composition of state revenues generally to heavier reliance on corporate being a higher proportion of state revenues than it was previously. And also slightly personal income tax is also a higher proportion, and because personal income tax has become more volatile. So yes, there is generally more volatility, and I think some of that we can see reflected in how the reserve fund recommendation has increased over time faster than the growth in the size of the state general fund.
And where we are right now in terms of the volatility, when did you last set the volatility thing? Was it last fall?
Yes, Mr. Chair, we did last fall, we set the
Does that get
volatility.
reevaluated if things like war and other things are hitting?
Yes, we reevaluate it annually, but we reevaluate it based on the historic data that we have available to us.
And related to not being able to predict things, obviously gas prices are only one of the impacts of the ongoing war, but if that lasts another month or so, will we be able to see impacts of that a year or 2 years out, or does that end as quick as the conflict ends?
Mr. Chair, well, I would say that in general, an energy price shock will have some lasting effects. It has effects certainly on consumers from the demand side. We think about higher gasoline prices, higher natural gas prices, but it's also going to have some significant effects on the business sector and the farm sector. The higher natural gas prices will translate into higher prices for fertilizers, anhydrous ammonia particularly. Higher input costs for diesel fuel. Diesel fuel prices are higher. Transportation costs for products in general. Operating costs for factories and import prices as well, because transportation is significant cost there. So those costs, that one-time shock to energy prices can have some lasting effects through the supply chain for many months to follow.
Senator Howe.
Thank you, Mr. Chair. And Dr. Becker, isn't it true that right now we've seen a spike in energy, but when you look at the long-range forecast for oil and that type of those products, that it's basically it's almost pre-war, pre-crisis numbers that, and actually, if this actually ends in a month, it'll bring more stability to the region, and actually our forecast will be actually better in the futures?
Well, Mr. Chair, Senator, the forecasts for future energy prices I think are evolving on a day-to-day basis. The futures prices, long run, are probably back to where they were previously, but my experience and my research with agricultural commodity futures is that often the futures prices are not terribly effective because they involve investment decisions as well as forecasts of future prices. So I'm not sure that I would necessarily base my forecast on that. And then the other issue is I think that there is just substantial uncertainty about what this, or how long the current difficulty with exporting oil through the Gulf out through the Straits is going to last. So that I wouldn't make any long-term forecasts on this myself.
Thank you. Any further questions from members of the committee? If not, we really appreciate this. It is encouraging news compared to November, but obviously a lot of heavy risks involved. And we appreciate your work on this and look forward to being in touch. And with that, this committee, we have Senator Pratt.
Well, thank you, Mr. Chair, and I just wanted to thank the Commissioner and her team for coming in, and Dr. Becker, I appreciate your insights. Just a couple of quick thoughts. I thought we were going to have a chance to kind of wrap up here, but, you know, I am concerned with the positioning of our $3.7 billion in the bank as a surplus. You know, as we've seen from the charts, that money is already spent. We are living off the carryover. We're living off the savings account. I agree with the Commissioner that non-wage income is extremely volatile. It's been good for everyone. When we look at capital gains, when we look at dividend income, anyone with a 401k, anyone with a 529 education plan, a mutual fund, or a pension has done very well. But you know, the S&P is down 1% since the beginning of the year, and you know, I agree. We need to be very cautious about extending that good news out into the future. I am concerned, however, with the revenue forecast on individual income tax. In my opinion, the implementation of paid family medical leave and that payroll tax associated with it is being a drag, and I think that is an optimistic view. When you look at the proliferation of artificial intelligence in the workplace and the dramatic increases in productivity we're seeing, we're already seeing some unemployment and underemployment in the new college grad young people and for young people. And you know, I was just listening to the Business Channel this morning when a former Fed governor said that we really need to look at lowering the tax on labor, that we are making it extremely expensive to hire people. And that's something that we as a state need to look at as well. And Mr. Chair, as we go forward in this session and we talk about, as you and I talked about just briefly last night, about what a supplemental bill might look like, I recall the Commissioner warned us that any new spending we do must be accompanied by offsetting cuts, and I just want to make sure that we get that on the record as well. So thank you, Mr. Chair, and for allowing me that time.
Thank you. For tomorrow, this committee will meet at 8:30 a.m. and we have two bills on the agenda, the dairy eligibility expansion and LCCMR. And with that, this committee is adjourned.